Literature and practice has been used to study investment decisions from a financial perspective. When looking specific to investments in smart public lighting, the investment itself will not lead to extra income. Instead, the general opinion is that it will contribute to lower costs and therefore lowering cash outflows or saving cash flows. Undoubtedly, replacing traditional lighting with smart LED, the use of energy will drop, and so will the energy expenditures. How much savings depends on different factors, which are case specific. In our previous videos, I have elaborated on 3 different capital budgeting techniques, most often used in literature: payback time, net present value, and internal rate of return. Outcomes of these calculations contribute in advising management in investment decisions. Especially the NPV and ERR shows the contribution to the financial value of the company. This holds for commercial companies, which would likely have a strategic objective to maximize financial value, i.e. shareholders of the company. It doesn't need further explanation to mention that public investments have a different perspective. Most often it will contribute to saving money, next to, of course, serve to the inhabitants of the municipality. And next to that, public governments are prohibited to increase equity by selling shares. They need to borrow capital from external parties to finance major investments. Because the risk a municipality faces default is close to zero, they can borrow capital with a low interest rate. But they will need to pay interest and principal repayments. Wrapping up public lighting investments can be typed as remaining investments, contributing to lower future expenditures and funded by external loans. From a financial perspective, the investment is approved when future cash flow savings cover the extra cash flow outflows. This is called the investment's cash flow savings. Well, you might think that would be the case when replacing current public lighting. Of course, that is true. Therefore, new installation of public lighting follows the rule that the option which leads to the least cash outflows could be on top of the list. This is if we take it strict financially. In the case of replacing public lighting, we identify effects on 3 different types of expenditures. Replacing traditional lighting will save energy, maintenance, and carbon emissions expenditures compared to the traditional lighting. Moreover, when estimating future cash savings, we need to predict related future developments. Next to that, when the investment is financed externally, extra future expenditures by interest payments and repayments of the principal needs are foreseen. Instead of calculating PBT, NPV and the ERR, we propose the total cash flow savings as being dominant for decision making in public area. By easily distracting the extra interest payments and principal repayments from the expenditure savings per year, cash flow savings are determined. Adding up all cash flow savings is called the total cash flow savings, the TCS. A positive TCS indicates a feasible project. Thank you for watching.